Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. Let's go look at FHLB. FHLB, you would look at fhlbanks.com, and they also have a financial data page, and there is an investor presentation, and this is also fresh off the press. So let's look at them. They show the mechanism, same thing, you and I are investors. We go through dealers, the Office of Finance divvies up the bucket of money to FHLB banks, they give it to the member banks, and homeowners come there and they get the loans and they pay the coupon back. What a great surprise. We get 5.7% coupon, homeowners pay 8% plus, but there is a very interesting thing that is happening here. You and I get 5.7% for 2 and 3 years callable. The homeowner is locked into 8% or 6% for 30 years. So FHLB actually makes more money in terms of the capital that they add to it. Having said that, it's not entirely true in the sense that there are homeowners who take variable rate loans. Even if a homeowner takes an 8% loan for 30 years, if interest rates crash, most of them will just go ahead and refinance their loan and get a new loan anyway. So, it's not true that FHLB will make more money on a every dollar basis, but their markup is higher in general because it's duration weighted. Having said that, then the question is, what is the quality of these loans? Let's look at that. What is collateralization ratio? If you come to me and say, Badri, can you give me $1? And I say, well, I see that you're wearing a really nice watch. How much is that watch? And you say, well, it's $1.50. And I say, sounds like a deal to me. You put that watch in this little box here. I'll lend you the $1. If you don't give me the $1 with the interest of 8 cents back, I will take the watch. Does that sound good to you? Well, that is what a bank does. They ask for collateral, and the FHLB is no dummy. The FHLB says, hey, for those who have more than $1 billion in borrowing with me, I will be very nice, and all you need to do is give me collateral for $2.70 for every dollar you borrow. And for all of you measly people that have a home mortgage that is less than $1 billion, you need to give me a collateral of $3.20 before I give you $1. I mean, it may sound terrible to you, but this is how it is, and this is why the institution has the stability it has, so we're all benefiting from it. So then you sit here and say, wow, they got a lot of collateral. You don't need to be worried about them at all, and I have news for you. You look under the cover and you say, where is their collateral? What kind of collateral do they have? Well, I suppose half of their money is tied up in single-family loans. And so if Jimmy John and Main Street doesn't pay their bank and the bank cannot pay FHLB banks, then I suppose FHLB can come in and reach out and say, I'll take the house on 123 Main Street, and that is what it is. But what worries me is the huge percentage, 21% of commercial real estate loans. And the reason that worries me is different. As we have all seen what COVID has done, there are giant office towers that are sitting empty. As time rolls by, if those office towers continue to be empty and those leases don't get renewed and their debt doesn't get serviced, there may be a problem here coming up. Now, if they have variable rate loans and they convert them into movie theaters and restaurants and housing, there are a lot of things that can be done. I just want to point out that the cracks are starting to show in FFCB, and that should say FFCB, my apologies. And FHLB, the cracks are not yet visible. However, FHLB arguably has a crater, not a crack, which is the commercial real estate loan. And so my moral in FHLB is to also keep my duration low. Having said that, common sense tells me that there is no way the Fed is going to let the mortgage market die away. And so it may indeed put pressure on the Fed to not keep interest rates high for a very long period. They do need to keep it high to tame inflation, but commercial real estate may take down the FHLB, and the Fed will never allow that. So there may be some pressure on decreasing rates sometime next year. Who knows? So Why do agency bonds matter now versus before? The first thing is in the longer term, in anything about 18 months, we saw earlier that the treasury interest rate actually is starting to decrease. And that means we got to go find some other place to park our money between 18 months and through 2 years, 3 years, whatever it may be. And the place we can park our money past 18 months happens to be agency bonds in a very healthy manner. Having said that, my word of caution to myself, and you do you, is to not go nuts and buy 20 years and 30 years and 5 years. I'm still staying somewhat duration constrained, even though they are callable bonds. Couple of lessons for you that I learned, and you do you. I only buy recently issued agency bonds, otherwise you will pay a commission on your brokerage, and I only pay par. I do not buy below par, and I certainly do not pay premiums. So the reason being, if you pay a premium, you have a call risk. If you buy below par, then you indeed have a higher tax burden because of the de minimis rule. And if you watched episode 16, 17, 18, and so on, you will know what that means. Okay, then we are going into what happens in the next 4 weeks. Let me remind you, the Fed has signaled that they will be fighting inflation until it is 2%. We may or may not be at peak interest rates. That doesn't mean interest rates are going to drop. So what does that mean? We got this itty bitty thing called this shutdown, which may or may not happen. And there is an excellent analysis by the Bipartisan Policy Center. And it points out, oh, this little thing. And this little thing is what was enacted in order to get out of the debt ceiling provision. And it says, hey, we have created an incentive for lawmakers to enact regular full year appropriation bills in a prudent manner. And here is that prudent thing. If Congress has not passed all 12 appropriation bills by the end of the year, just so you know, the Senate has passed all 12 and the House has passed 0. So if the House has not passed it by January 1, 2024, then everybody loses 1% in the ability to spend, except it's not 1% as of today, it's 1% as of 2 years ago, which is a pretty big hit. Here is what that does. That becomes a poison pill, so everybody better come together and get this done before the end of the year, or everybody loses. So then the question is, how do we get it done? And even if we go past January, then we have until April 30th. And if you don't get the job done, meaning if the House and the Senate cannot agree by end of April, then you are stuck with 1% for the rest of 2024. And that will hurt the economy really bad. So here are the minimum versus maximum chaos scenarios, in my opinion. The first one is, in the perfect world, calm sailing, we may have a continuing resolution bill that is signed in the next couple of weeks, and it kind of punts the work to be done until December 31st. Everybody comes together and they say, kumbaya, we're going to move this ahead. The parties are going to work together. The end, we resolved it. Thank you so much. We don't need to revisit it. That is the perfect scenario. The complete disaster scenario would look possibly something like this. We don't get anything done by January 2024. There is a shutdown, and the Speaker of the House, who is in the opposition party, says, hey, I'm going to try and get us together, because at the moment the Senate has all the 12 bills passed. It's the House where there's a problem. There is a poison pill in the House, which is that any member can bring a resolution to vacate the Speaker, and they put the motion to remove the Speaker on the floor, and the Speaker is removed. Remember, this is the worst case scenario. Now there isn't even a Speaker to get the job done. We are in very uncharted territory in the beginning of January. So that's the left side is the best case, the right side is the absolute crazy case, and reality distortion is most likely what is going to happen. If the debt ceiling debate is any indication, we're going to be told, don't look at the man, look at this little kid, look at how beautiful this is, we got this done. What do I mean by that? The most likely scenario, in all likelihood, there will be a short shutdown in January. And the reason I say that, go back in history, Every previous administration, left and right, had a small shutdown in year 3. That's kind of the way for the opposition party to say, oh, look, this one is screwed up, elect us. And then the other one says, well, that one is screwed up, elect us. So year 3 shutdown is becoming a terrible habit, and it will happen. And then when the government is shut down, the politicians say, we're going to be heroes, we're going to come together. And you throw a ton of pork and you actually increase the spending. And then a couple of shiny objects, I totally hate this one, we're going to cut down spending there. I totally love that one, we're going to, increase spending there. Everyone claims victory, America is saved. And in the meanwhile, what in the world happens to the markets? I don't know, but here is what I'm going to do. I am not going to look at the man behind the curtain or the young kid on the phone. I'm going to say, you know what, I'm going to stay out of stocks. Only, this is me, you do you. I'm only going to hang with short-term treasuries and just have cash on hand and wait until January. So everything that matures, I'm going to keep rolling it into January maturities. There may be some turmoil at the beginning of January, I don't know, but my recourse to any turmoil is to go to cash. I will increase duration, but most likely in January. Until then, I'm going to sit tight. You do you. Thank you for listening to Yield Nerd.